If you are looking to start trading Ethereum this year, there are a few tips you should keep in mind. The 3 tips are buying directly from other owners, using dollar cost averaging, and day trading. Buy directly from other owners. A well-conceived and executed decentralized exchange may just have you covered. Besides, there's a lot of competition for your money. You're not going to get a one of one. To help you weed out the good from the rest, we've put together a list of the most trusted companies in your pocket. The resulting list is the best place to start. A decentralized or cryptographic exchange has all the advantages of a well-managed institution sans the hassle of actually executing a transaction. For example, a well-run cryptographic exchange will have a minimum deposit of $100 and an average balance of $750. That's a ton of dough for the average Joe. This makes it a convenient and safe haven for cryptographic exchange users. So, which cryptographic exchange to choose? Use dollar cost averaging, DCA, to minimize losses. Dollar cost averaging, DCA, is a great investment strategy. It is an automated investing technique that enables investors to set up a plan and make regular purchases. This can help relieve stress and allow investors to focus on the future benefits rather than the current price fluctuations. DCA can be used with a variety of securities, but is particularly useful in crypto investments. Many exchanges offer automatic purchase features. However, it is important to ensure that you are investing only in a sustainable cryptocurrency and not a speculative one. Dollar cost averaging is an excellent tool for investors who are hesitant to put all of their funds into one investment. It takes the emotion out of the equation and allows investors to spread out their purchases, thereby lowering the risk of a major financial loss. The DCA strategy is beneficial for both beginners and experienced investors. It can also be a good hedge against volatility, as well as a way to build wealth. Dollar cost averaging can be used with a variety of assets, including stocks, bonds, and commodities. As with all investing strategies, it is important to use independent advice. You may be better off making small purchases on a bi-monthly basis instead of daily. In order to apply dollar cost averaging, you need to set up a budget and a schedule. For example, you might decide to buy a certain amount of Ether each week. By purchasing a small amount of Ether each week, you will avoid committing a large lump sum of money to the asset. While it is true that you might miss out on a larger profit when using dollar cost averaging, it is a good long-term strategy for conservative investors. It will lower the overall cost of investing, and it will minimize the risk of losing a large chunk of your savings when digital currency markets decline. However, if you are a beginner investor, it may be better to wait for more experience before relying on this strategy. Even experts can have a difficult time timing the market. And the truth is, nobody knows when the market will bottom. Seasonality is important. If you're a crypto investor, then you've probably heard of crypto seasonality. Crypto seasonality is an important factor to take into account if you're planning to trade in cryptocurrencies this year. The price of various cryptocurrencies tend to fluctuate significantly during the different months of the year. There are several factors to consider before you decide to invest in a specific coin. First, you'll want to make sure you're getting the best price. Secondly, you'll want to be sure to hold on to your investment as long as possible. You also want to be aware of the fact that there will likely be some volatility in the future. Another thing to keep in mind is the fact that you'll need to take into consideration your own individual risk tolerance and return expectations. While you may be able to make a profit from betting on a particular asset's seasonality, you'll also be exposing yourself to more risk. To help you better understand how a particular asset performs in different seasons, you can look at historical performance data. For instance, you can compare the amount of money that has been spent on a particular currency in a certain month. For example, you can see that the price of Bitcoin has been relatively stable during the first quarter of this year. During the same period, there were significant fluctuations in the price of other assets. Using a single-factor regression, you can learn that the slope coefficient on Cs is quite large. This means that the monthly gain frequency is fairly high. In addition, you'll be able to look at the same regression for risk-adjusted returns. These results show that the seasonal effect has actually had a positive impact on returns in the past. Finally, you can look at the calendar effects that are involved in the seasonal effect. You'll notice that the US equity markets performed very well in January, while they were not so hot in May and October. Clearly, the seasonal stock market effect has an impact on your chances of making a profit. But there are a number of reasons why it may actually be a negative factor for the long-term investor. Day trading is the riskier option. Day trading can be a good way to earn money in the crypto market, but it can also be a stressful and risky activity. If you're looking to trade, be sure to take the time to learn about the basics of the market and develop the right trading strategy. Fortunately, there are several different strategies that can help you maximize your success. Day trading is a popular investment method that involves making numerous buy and sell transactions in a day. Traders rely on technical analysis and news analysis to make these buy and sell decisions. Unlike other forms of investing, day trading is a relatively quick process. Day traders will need to choose an exchange. Some are centralized and more user-friendly, while others are decentralized and offer a more private environment for trading. A centralized exchange may have higher fees, but it offers less privacy. On the other hand, decentralized exchanges are cheaper and allow investors to control their own trades. One of the main differences between the stock and crypto markets is the fact that day trading is based on volume. Traditionally, brokerages and trading houses were the only means for buying and selling assets multiple times during a single day. The high volume of trades and a quick turn of events make day trading a very exciting and adrenaline-inducing experience. While many day traders use leverage to expand their accounts, it's important to remember that there is a risk involved. This means that the trader must set aside enough money to cover possible losses. As a general rule, it's best to avoid day trading on cryptocurrencies with very high volatility. You'll also want to have an adequate understanding of the market structure. Specifically, you'll need to know what the standard deviation from the mean is, how the markets move, and how the market works. You'll also need a secure wallet for your cryptocurrency. It's important to have a reliable method of transferring your assets between your crypto wallet and your exchange. Many exchanges do not allow withdrawals during the crypto winter. Having a secure and convenient way of storing your coins can enhance your security.